All right. Very good evening, students. So, today we are going to talk about something very important for all of you from understanding perspective. So, we will start with a chapter which is important, which happens to be the fundamental of all, which is rules of debit and credit accounting procedures. So, I believe the preceding chapters you are clear about, but today for the subsequent chapters to work upon, it is important to have a thorough conceptual understanding on rules of debit and credit. You may have heard of many a times debit credit terms in even our normal conversation, but to understand it from accounting perspective, a little more deeper understanding is required. So we will start with this chapter. This here we have these few points which you will be able to understand, which happens to be the learning objective. So it will help you understand what is an account, meaning of debit and credit. Now, what do you mean by it? If in case you need to explain it in one sentences or so, you will understand this. Rules of debit and credit. What are the rules that are associated with debit and credit? Classification of accounts. How the accounts are classified, and in order to decide what rule is applicable there, which depends upon the classification of account. Now, balancing of account, how a balance is done in accounting, any particular account, how we derive to a balance of that particular account. Significance of debit and credit balances. Now, what does it mean if it happens to have a particular account has a debit balance and another particular account has a credit balance? So what does it mean? So these are the some these are the understanding which is required, which happens to be the premise for your subsequent accounting processes, which you will be learning with respect to preparation of journal, posting them into ledger. So this chapter is the fundamental of the subsequent chapters. So I would expect all of you to understand it deeper, so that from conceptual perspective you will have an understanding. We will see its application in the subsequent chapter as well. Let's see how it goes. I would give you a brief understanding by talking about a business setup. Let's say this is a particular sweet shop. Now, in this sweet shop, there is an owner who is sitting here. So he is the owner. Then there is there is an owner. Then there is a manager. So he's a manager, and there is an accountant. Now let's understand what is that we are going to understand from this particular visual. So owner happens to take decisions with regard to buying of materials, raw materials, which are required to be processed in order to make processed goods, or in our case it is sweets, which as per the buying which is done, it requires some raw material, which is decision is taken by the owner. Then decision is also taken by the owner with regard to who are likely to be the team who is going to make it. So there is a team who is also required to be identified. Maybe the person who prepares it has expertise of preparing sweets. Then who are the people who are going to take care of the floor of the sweet shop, maybe cleaning, utensils, everything related. So but these are some tiny decisions which are taken by the manager, but important decision which is crucial for the business as a whole is taken by the owner himself. Now what happens, this owner, he goes to the market, and from market he decides a vendor. So there is a market, he decides who is going to be the supplier from whom he has to get the material to the floor of the shop in order to process it into finished sweets. Then from market he buys the raw materials. Then who is likely to be the buyer? Maybe some enterprises nearby, or some schools, or anybody can be buyer, maybe individual buyer, and even bulk buyers as well. So in both the scenario, if you look at the decision, these are material decision for the business, which is taken by the owner himself. Now comes, there is a second manager who happens to take floor level decisions. And if there is any deal which is done by the businessman from the supplier who is outsider, so what happens that he has given an order to supply certain goods to the sweet shop, the ingredients or the material to the sweet shop. Now, when he happens to goes to the accountant and tells that payment is to be made to Mr. X, who is a supplier of our material. Now, merely by stating the fact that there has been a buying done from Mr. X for the sweet shop does not suffice the requirement of an accountant to enter the transaction. This is a transaction in the books of account. So accountant in turn asks the owner, please give me the invoice, the bill which is given by the vendor, because basis the bill or the invoice, decision with regard to entering it in the books of accounts is dependent. So therefore, the owner merely by stating that such and such transaction has happened will not suffice as a proof for the accountant to enter in the books of account. Therefore, he verifies it with, he asks for the invoice and he verifies the invoice, and accordingly he enters in the books of account. Similarly, the accountant who submits end of the day report to the accounting stating that such and such cash sales has happened today. Now, merely by stating statement given by the manager to the accountant, this of the cash sales that has happened does not suffice. Then accountant in turn needs to ask for the documents to be submitted, such as there may be some mechanism to trace the cash sales that has happened, maybe the count of the token and the amount which is written on the token, the sum total can be the cash sales which can be reflected here, which can be submitted, and it is verified by the accountant. Then in the books of account it gets entered. Similarly, if there has been credit sales that has been done, that report also alongside the proof of transaction is to be submitted by the manager to the account in order to process it in the books of account. I believe this particular setup and the likelihood of transactions which are likely to happen in a sweet shop, you must have understood likelihood of the key areas of work that is done by individuals who are seen here, be it the owner, be it the manager, or be it the accountant. So accountant has to take up all the details and verifies it and accordingly enters in the books of account. Not merely a statement whether it is given by the owner or it is given by the manager or anybody happens to establish a proof of transaction. So this is very important. So entries are made easy. This is the evidence that has been submitted. In our case, maybe purchase invoice which is submitted by the owner to the accountant, or any cash sales, the tokens, count of token which is submitted. So anything that can be verified as a proof of transaction, which is the subject job of an accountant to verify and accordingly enter in the books of account. Now, the rules of debit, how he enters, he follows certain rules, some principles. So there is a rule of debit and credit which we will understand is followed for each transaction. Where to record? So there is a journal or a special purpose books, which is cash book, bills receivable, bills payable, other special purpose books, purchase book, sales book. Where to enter? By applying the rules of debit and credit, accountant does the rest of the work. Means put up the balances, put up the transaction into the ledger, which ultimately gives up a sum up view of that particular account, what all transactions have happened and what is the final balance of that ledger account. We will see that with example in a while. Now, meaning of an account. Let's see, an account is a record of transaction. First thing we have to understand, it is a record of transaction under a particular head. It records not only the amount of transaction but also their effect and direction. Now this is very important. Meaning of an account. Account is a record of transaction under a particular head, I'll explain you each one of these terms. So particular head, it records not only the amount but also their effect and direction. Now how it is to be done. So we will see, let's say there is Ram from whom some purchase has happened. So Ram account gets created. So this is Ram account. Now as per the account, entries are to be made. So there, this side of the account is called debit side and this side of the account is called credit side. If a particular transaction happens, particular head is Ram. Now there is an amount column. I'll draw it here. So this is amount. This is amount. There is a date column. This is date. Now there is a date. Just for understanding sake, now understand this. This is particular. Okay. So any transaction from Ram which has happened in the business, his account either will be, entry will be either made on the debit side, means left hand side, or on the credit side, which is right hand side. So this entry is based on a particular journal where the entries have been initially recorded. From there a ledger account gets prepared, as in our case it is Ram account. So account which has debit side, credit side, there is a defined particulars to be mentioned there or items to be mentioned there, and which side of it requires to be entered, that we will learn through the rules of debit and credit. Is this clear? So this is an account, is a record of transaction under a particular head. This is a particular head. It records not only the amount is entered, but also their effect and direction to whose account the other side entry is made. I have given you the format here. Now I'll touch upon the next part, which is meaning of debit and credit. Let's see what is debit. Debit refers to the left hand side. In our example, we have seen towards the left side is of an account is debit, and credit refers to the right hand side of the account. Now the rules of debit and credit, this is very important for all of us to understand what are the rules. Now under double entry system means every transaction is recorded considering its dual effect, not singular effect. One, if purchase is done from Ram, so purchase will be entered and Ram will be entered. So this is double entry system of accounting. Each transaction has two aspects. One is debited, the other one is credited. So in our case, if purchased by the owner of raw material, so there is one thing that has come up in the transaction which is purchase, and the second which has come up is if it is bought from Ram, who is a supplier, so we will Ram account. So this is one account, purchase account, second one is Ram account. Is this clear? So there is a debit which is to be debited and which is to be credited. We need to follow a rule. I'll tell you what is the rule. Now, which account is to be debited and which is to be credited, the rules on the basis of which decision is taken is called the rules of debit and credit. I hope this is understood. Fundamentals you have to understand. This is very important. Then only the subsequent thing you will be easily able to understand. Let's see. Now, before we move on to the rules and the basis how the accounts are classified, I'll touch upon the classification first. Classification of account. So there are two methods. One is traditional method and second one is modern method. All right. So what is there in traditional method? By and large, it remains the same. Just some special terminology that has come up. So traditional method, there is personal account, there is impersonal account. Now personal account means which is a natural person, Ram, Shyam, Hari, Gopal, their name is important and he is a living person. Artificial person may be an enterprise. Okay, enterprise like ABC sweet shop, ABC stationery shop. So artificial person. And representative person, for example, there is overdraft, loan from bank. So there is a representative personal account. They are actually not individual, but it represents a person. This is Ram's loan or Hari's loan. If you have taken loan, given loan, so there is a representative personal account. Then comes real account. Anything that we happen to see, physically touch, or anything which is bought in the business for running the business, which is real account, that is assets. Let's say land, building, machinery, plant, they are all real assets. Debtors from whom we have to receive money, or even goodwill is an asset, but fictitious asset. Nominal account, which touches upon the expenses. So we have seen impersonal account, which is real account, assets, and nominal accounts, which are expenses and income. All right. So basis the traditional classification, personal account and impersonal account. So personal account touches upon natural person, name of an individual is important. Artificial person, enterprise name. So if a particular shop like sweet shop, it buys goods from ABC, so it is not the owner who is buying. We have seen owner, business and businessman are two different entities. So all we are talking about is business as an entity, not the businessman just of a firm. Now we will see modern classification. Now there is an asset account, they have named it categorically. So individual assets account, liabilities, there are liabilities. Capital account, which is nothing but the liability of the business to the businessman. This liability of the business to the outsider. So this is how the classification between outside liability and capital account. Revenue account, which is related to anything that generates revenue for the business by doing the core activity. For example, by selling sweets in the sweet shop, the revenue that gets generated is revenue account. Expenses account, anything which is the expenses which are done in order to run the business smoothly. Certain expenses are important, like salary of an accountant, salary of a manager, salary of the staff. In a sweet shop, we have seen all these rent of the shop. So everything which are incurred in order to run the business with efficiency are called expenses. So I hope this modern classification is clear. The name itself gives you a bigger understanding what it is going to be there. Now what are the rules of debit and credit? So this is something which has to be understood at basis which we will enter in the books of account, or even an accountant follows the same. So first thing what he has to understand is to classify whether it is a personal account, real account, or nominal. Now we have seen what is personal account, where name is important. Of if in our case the supplier who has supplied us goods on credit, so his name is important. The firm's name of the supplier or supplier's firm's name is important, so we need to we need to consider it as his personal account. So if there is rules of personal account, if we talk about, debit the receiver and credit the giver. So in our example, we have bought goods from the supplier, so debit the receiver. Who is receiving? It is the business which is who is receiving. So when we are receiving goods, there is a term that is used by the business which is called purchases or goods. So this is not a real account. Purchase or goods, not a real account. But there is another important, credit the giver. Who has given us? So there is Ram, from whom we have bought the goods. So Ram account is required to be credited, and the rule says that debit the receiver, credit the giver. So this item is personal account and he is a giver, so his name is credited. We will see why this is to be debited, but for now you understand Ram account is required to be credited because it is a personal account, and rule of personal account says that credit the giver, so we have credited if it happens to be on credit. So we have understood now personal account, how entries are made basis applying the rule of personal account, which says that debit the receiver and credit the giver. Now when it comes to real account means, we have already discussed this. So real account, which is assets, so there is any increase or decrease in assets. So if how we are going to enter this increase in asset, so we need to debit that because it shows debit balance. So if supposingly furniture is bought by the business for its business purpose, so and what we are going to do, this account is furniture. So furniture being a real account, we need to debit it because furniture is coming in the business, so we need to debit this. And what is going out against the furniture? We are paying them cash. So cash is going out. So we will credit cash. Now, impact of this is, since this is an asset, so by debiting it, there is an increase in asset, and cash is going out. By crediting it, there is decrease of an asset. So real account rule says debit what comes in. Whenever there is increase in asset, we need to debit it, and what going out, if there is an asset which is going out, we need to credit it. I hope this is clear. And let's see now the nominal account. Now, debit all losses and expenses and credit all income or gain. Now, losses and expenses, which is expense. If there is any loss, maybe our profit loss says that there is a loss that has incurred, so loss is debited. So these are debited. Whereas credit all income and gain. So if there is any credit or if there is any income, so it requires to be credited. For example, interest on interest received, it is an income. Commission received is an income. So it requires to be credited. So income or gain are credited. Expenses and losses are debited, as if the account falls into category called nominal account. So we have seen what are assets, real account, personal account, and nominal account. So real account talks about assets, whereas personal account individual name, and then nominal account related to expenses and income. I hope this is understood. Now let's see the next one, balancing of an account. Now how we happen to do the balancing of an account. So as we have seen the account, let's say the same example, I will draw here Ram account. Now this is in the middle, we draw two line in order to have an understanding that it is bifurcated into two equal parts. Then there is a particular line furthermore. So we will see here, this is an amount, this is an amount, then there is date. We'll write here date, amount, sorry, particular. So this is particular, we will write here particular, then amount, then again date, particular, and amount. And there is also a journal folio. So before amount, we write here a journal folio. Usually we don't enter it from practical perspective, but just to understand that which page of journal this account has been or this entry has been made. Just an easy reference for the person who is referring to the book. Now, if we see here how the balances are to be balancing of an account. So let us say Ram account. So Ram account is a supplier for our sweet shop. So he supplies certain material to us. So what is the that we will how we are going to enter it in the books of account? So purchases debit to Ram, since it was done on credit 2 months later or 1 month later will make him payment. So we will enter here in credit side by purchases. So how much of goods we have purchased? Let's say 10,000. Okay. Now we have to pay him. So 2 months later, we have made him payment. Let's say we have made him payment of 8,000 rupees. So what is that? As per the rule, what it says, real account rule says that debit the receiver, debit what comes in and credit what goes out. So when cash is going out, so how entry is to be? Cash account is to be credited, and debit the receiver and credit the giver as per personal account. So Ram happens to be the personal account. So he is the receiver, since we are giving him money, cash, against the purchases that we have done. So Ram account is required to be debited. So Ram account debit to cash, let's say 8,000. We will enter here 8,000 rupees. And this purchase was done, let's say 1st December 2025, okay, or 24. Let's now 10,000 rupees of purchases which was done. I will now refer to what is the balance that I have after having done the payment of rupees 8,000. From just oral counting, we can very well say, but what our accounts is, if there are hundreds of such accounts to be maintained, it is difficult to remember. So we need to refer to the balances each of our account happens to show us. So we will see here this is the credit side. So we will draw one line here. Then again, this is the debit side. We will draw it here. Okay. Now the side which is higher appears in total as higher. So we will roughly total it here. So it comes, this side is larger than the debit side. So we'll write here the total value. Here also we will write the same. So same value is written here, 10,000. Now we will balance it. So what is the difference that this account is showing? So 10,000 minus 8,000, what remains is 2,000. Okay. So here we will write to balance carried. This payment we made, let's say 15th of December 24. Now, when we are balancing the account on 31st of December, so let's say every year or every month end, or every year end. So this account is being balanced on 31st December 24. So two balance carried down. How this balance we have received? By balancing. So balancing figure gives us this balance, which is the difference between the credit side. So we write here debit, and this is our credit side. So our credit side total is higher than that of the debit side, so the difference will appear on the debit side of the account. And if the debit side total is higher than the credit side, then the difference will appear on the credit side of the. Supposingly, if we would have made him payment of 12,000 rupees, so our balance would have appeared, total would have been 12,000, here also 12,000, and purchases were only 10,000, but the payment is made 12,000, so there is an advance payment made to him. So that balancing figure will appear here. Now this balance gets carried on to the next month. So how we are going to, or next year. So let's presume it is next month. So I'm carrying this balance on 1st of January 2025. How I will write it here? So I'll write here to balance brought down is remain to be paid to Ram. We can immediately refer to the book, and the book will say there is 2,000 rupees that is there to be paid yet. So this is our balancing figure of Ram's account. I hope the rough understanding of how the balancing of an account is done is understood by you by now. Let's see now significance of debit and credit and balances in account. So a debit balance is either an asset, cash, bank, etc., or an expense like salary, rent, etc. Till the time it is paid, our expense account will show a balance. Once it is paid, the same amount, if it is paid, then there is no balance. Cash, there will be balance. Bank account, there will be balance. Whenever there is sales done, cash is coming in, it gets credited to cash account and it appears there. So this is the debit balance is either an asset or an expense, which we have seen. Now credit balance shows the income earned or liability or the amount invested by the proprietor. So if supposingly income earned, there is a sales made. So if there is sales done, but we have not received the money, since it is accrual basis of transaction. So sales will always show a credit balance whether money is received or not. If sales is done, it will show a credit balance. There is an income earned through sales, so sales is showing a credit balance. Or liability, if there is an outstanding salary, outstanding means not yet paid but services already received. So salary for the month of, let's say, January is yet not paid, it is an outstanding. So liability, income will show credit balance. If there is a liability, it will show as a credit balance. If we have invested something in some other organization's share, for example, or amount invested by the proprietor to the firm, then it is a liability to the proprietor. So this is very important thing, that anything which is due by the business to the outsider is a liability. Anything which is due by the business from the outsider is an asset. Liability shows credit balance, asset shows debit balance. If liability should show credit balance, so if there is any liability which is appearing in the books of account, it will show a credit balance. If there is any asset, it will show debit balance. I hope this is clear. So clear credit balance and debit balance, what is the meaning of it? Though we will understand it little more deeper, but for now, at the surface level, keep this understanding that debit balance, assets always show debit balance, liabilities show credit balance, expenses always show debit, and income always shows credit. So I hope we have touched upon all the important aspects. So I'll again we will go through whatever we discussed today and summarize it so that it becomes a recall for all of you. So we will see here what we have touched upon. So we have seen the learning objective, meaning of an account. So we have learned what is an account by I have drawn that equal sided both two sides, debit side, credit side, with an equal partition, and how the account appears. Meaning of debit and credit, we have learned what is the meaning of debit and credit, which side of an account is debit, which side of an account is credit. Then rules of debit and credit also we have seen. First of all, we need to classify the account, which is real account, personal account, and nominal account. And there is a rule for a specific nature of account. If it happens to be the personal account, the rule says that debit the receiver and credit the giver. If it is a real account, debit what comes in, credit what goes out. And if it is nominal account, debit all losses and expenses, credit all income and gain. This is the rule, meaning and rule of debit and credit, what we have understood. Classification of account, whether it falls into personal account, real account, nominal account. There is modern classification, traditional classification that we have already seen. Balancing, how we have to balance an account. I have given you one example, Ram's account. The total amount of purchase that has been done on credit from Ram was 10,000. The payment made in between in the month was say 8,000. So what was the balance? 2,000 balance, which was carried down to the next month. Now, significance of debit and credit balances. So what is the meaning of the fact that if a particular account is showing a debit balance, so assets will show debit balance, means there is asset owned by the business. If the liability should show credit balance. If the business has liability, it will show credit balance. So credit balances which are appearing, be it the liabilities for the business, which is the amount to be paid by the business to the outsider, it is considered as a liability. So liabilities shows always credit balance, assets always show a debit balance, expenses always show a debit balance, and income always show credit. So credit balance, significance of debit balance and credit balance we have seen, and we have understood this shop, how the what all activities which takes place in a shop. In order to understand majorly the proof of happening of a transaction is required to be submitted to the account. Once it gets submitted, the accountant verifies the document submitted to him, and if he is convinced with it, he enters in the books of account. This is important, that anything that gets entered in the books of account, it is presumed that it must have been verified with the associated document. That is why accounting informations are reliable. So I hope this part is clear. This particular chapter, which touches upon the very core fundamental of the journal entries that we make at the initial stage. So you must have understood this, and how we are going to apply them when we are working out certain journals. You will be able to apply these learnings, which will help you furthermore understand from application perspective. I hope this is clear now. So before I close, I would like to thank you all for listening to me, viewing this. So far we have touched upon, I'm going ahead sequentially to make you understand, so that in my playlist everything is there sequentially and you can refer to them to understand. I would expect you to like in case you have liked it, or dislike in case if you have any. But I would also expect you to subscribe, share it to the students of your class, so that they have or in your neighborhood, so that they also happen to learn this. Mention feedback in the comment, because this is something which I personally always look forward for, how the students are taking these lessons. If there is any feedback, if there is furthermore incorporations to be done in order to improvise the whole process, I certainly would like to take up your positive feedback, or any feedback which is related to improvisation with respect to your understanding. I can accordingly do the incorporations. I would also expect you to connect. If you have any query, you can mail me on the mail here, mail ID which is written here. So next class we will work out few questions on this particular chapter so that a little more deeper understanding you happen to develop. So for now, I'm taking leave. Thank you so very much. Wonderful talking to you all.